Welcome to this explainer where we're breaking down the key signals moving the global markets. From Washington to Beijing and from digital assets to physical gold, the board is shifting in some really interesting ways. Okay, let's dive right in.
So, we're going to start with a signal that frankly would have been absolutely unthinkable just a few years ago. A high-ranking U.S. official is publicly acknowledging the anniversary of the Bitcoin white paper. And they're not doing it with a warning, but with a statement that almost sounds, well, like an endorsement. This is way more than just a calendar reminder.
So the big question this raises is, are we actually watching a major policy shift happen in real time? A move away from all that skepticism and a step towards integration? All the signs are really starting to point in that direction.
And this one signal, it could be part of a tectonic shift on the global stage, one that involves the very people who make the rules for international banking.
At the very heart of this is the Basel Committee. Now just think of them as the regulators for the world's biggest banks. Their rules pretty much decide what's too risky for a bank to hold. And for years, let's be honest, they've treated crypto like it was financial radioactive waste.
Now, what's really fascinating here is the complete 180-degree turn. The old rules were basically designed to keep banks far, far away from crypto. But now, the US, the same country that once called this space the Wild West, is actively lobbying for friendlier rules. This isn't just opening the door. It's like they're rolling out the red carpet.
All right, so as the West seems to be softening its stance on digital assets, let's shift our focus over to the East, because China is making a very different kind of move on the world's oldest hard asset, gold.
As of November 1st, a key policy that actually encouraged everyday people to buy gold in China is just gone. The government has gotten rid of a long-standing VAT tax break, and this change is happening right now.
So, what's the bottom line here? This new rule makes buying physical gold more expensive for the average Chinese citizen. It doesn't matter if it's investment bars, coins, or even jewelry. The price just went up. And the intended effect? Well, it seems pretty clear. To cool down that massive retail demand for gold that we've been seeing.
Okay, so with those two major policy shifts in mind, let's zoom out and look at the broader market picture from October. And, well, if you were looking for a clear direction, you're not going to find one. The month was just a giant bundle of contradictions.
And this just perfectly illustrates the confusion. I mean, look at this. Stocks, bonds, gold, and the US dollar all finished the month higher. You have traditional safe havens and risk-on assets all rising together. Meanwhile, riskier assets like crude oil and the broader crypto market, they were down. This is not a typical picture at all.
And the contradictions just keep coming, even within the same asset class. For crypto, October actually broke a 6-year winning streak. But while the whole market was falling, Bitcoin itself decided to buck the trend and hit a brand new high for the year. That's a pretty clear divergence.
You can really see this conflict between price and what people are actually doing with their money in the fund flows for digital assets. For the month, investment funds saw a net outflow of $191 million. And this wasn't just some blip. It was the third week in a row that money was leaving the space. And it wasn't just small funds either. As you can see, major institutional players, we're talking BlackRock and Fidelity, saw significant withdrawals. From the big money perspective, that paints a pretty bearish picture. So, what are we supposed to make of all this? Stocks are up, crypto funds are seeing money leave, but Bitcoin's price is strong. Where does sentiment actually stand? Well, one key market indicator is flashing a signal of extreme and maybe even dangerous optimism.
So, we need to look at a technical indicator called the call/put skew. Now, in simple terms, it's just a way of measuring the demand for bullish bets, those are called call options, versus bearish bets, which are put options. When the skew inverts, it means investors are basically rushing to place bullish bets and completely ignoring any downside protection.
Now, analysts from Goldman Sachs are flagging this because it's the first time we've seen this kind of inversion since December of last year. It suggested investors are overwhelmingly, almost unanimously bullish. And historically, when sentiment gets this one-sided, it often acts as a contrarian indicator, popping up right before the market takes a pause or even reverses course.
So it leaves us with this final, really thought-provoking question. You know the saying, the market climbs a wall of worry. But what happens when there's no worry left? What happens when absolutely everyone is on the same side of the boat, expecting nothing but clear skies ahead?
For more news and in-depth data, check out our Telegram channel. The link is in the first comment. That's your Daily Edge. See you next time.